rosy expectation. Inadequate allowances for depreciation. Let us now consider examples involving the opposite type of situation, viz., the use of accounting methods by corporations that give rise to inadequate allowances for depreciation. Particular attention must be given to the vogue for drastic write-offs of fixed assets for the admitted purposes of reducing the depreciation charges and thereby increasing the reported earnings. This practice had its inception during the 1927 to 1929 boom, but its widest development took place in the ensuing Depression. Two typical cases are selected for discussion. Effect of writing down fixed assets. Unit, $1,000. Examples. Early in 1933, the United States Industrial Alcohol Company and the Safety Car Heating and Lighting Company announced plans under which the property account was written down to a net value of $1 by means of a corresponding reduction in stated capital and surplus. The transactions may be summarized in the condensed balance sheets shown in the table that may be found in the accompanying PDF. The United States Industrial Alcohol Revision was accompanied by a statement to the effect that, by reducing the book value of fixed assets to $1, the necessity for future charges for depreciation would be eliminated. It was proposed, however, to set up a reserve for replacements account by charges against income of amounts deemed sufficient to provide for the replacement of productive facilities. It was believed that for 1933, an adequate amount of such charge would be $300,000, which might be compared with approximately $900,000 charged against income for depreciation in 1932. The safety car announcement carried the idea even further. No provision for depreciation was made in 1932, so that a net profit was reported for that year against a loss for 1931, although income before depreciation was smaller in 1932. It was stated in the annual report of the company for 1932 that, by the elimination of depreciation on fixed assets as of December 31, 1932, all profits above operating expense and depreciation on subsequently acquired capital assets could be considered by your directors for distribution to the stockholders without any decrease in the company's current assets. Earnings manufactured from depreciation account. The procedure followed by Safety Car is identical with that of our imaginary trucking company C, which wrote down its truck to $1 and thereby avoided charging depreciation to earnings. We have already pointed out that if depreciation must be allowed for in fact, it cannot be eliminated by bookkeeping entries. The safety car stockholder does not earn $1 more on his investment because his fixed assets have been written down to nothing. Nor can necessary expenditures for plant upkeep or replacement be in any way reduced by making believe that there no longer is any plant. Let us examine the safety car heating and lighting exhibit in somewhat the same manner as that of Eureka Pipeline. Over a 10-year period, the expended depreciation charge averaged about $500,000 per annum. The earnings record for the decade is approximately as shown in the table found in the accompanying PDF. If this company were analyzed amid the uncertainties of 1933, it would be impossible to determine whether the long-term or the recent figures are a better guide to the future. But whatever assumption is made on this score, it is quite clear that a depreciation charge must be allowed for. If no better than the 1932 results can be expected, then a very small earning power at best would be indicated, since actual expenditures on plant will no doubt come close to, if they do not exceed, the reported earnings of $233,000. If by any chance the profits should return to their 10-year average, the complete elimination of the former depreciation charge would result in a serious overstatement of the true earning power. Sequel, 1933 to 19 charge against 1938 earnings for amortization of these buildings and leasehold improvements amounted to $3,925,283. Since these items belong to the amortization group, they lend themselves to the same kind of arbitrary treatment as do the others. By making the annual charge against surplus instead of income, or by writing down the entire capital investment to $1 and thus eliminating the annual charge entirely, a corporation can exclude these items of operating cost from its reported per-share earnings and thus make the latter appear deceptively large. Amortization of patents. In theory, a patent should be dealt with in exactly the same way as a mining property. That is, its cost to the investor should be written off against earnings during its remaining life. It is obvious, therefore, that charges made against earnings by the company, which are based on the book value of the patent, have ordinarily little relevance to the real situation. Consideration of this question belongs chiefly to a later chapter on amortization from the investor's standpoint, and to avoid dividing our treatment, we shall postpone to the same place our brief discussion of the accounting methods relative to patents encountered in corporate reports. Amortization of goodwill. This is a matter of very minor importance. A few companies have followed the rather extraordinary policy of charging off their goodwill account against earnings in a number of annual installments. Examples: Radio Corporation of America charged $310,000 a year for this purpose between 1934 and 1937. This was applicable to the goodwill account of its subsidiary, National Broadcasting Company, and was discontinued in 1938, although $1,876,000 remained unamortized. Obviously, this practice has no factual basis, since goodwill has no duration of life apart from that of the business as a whole. Where the item is of any size, the analyst should adjust the earnings by canceling the charge. Chapter 35. Public Utility Depreciation Policies. Omission of depreciation charges. In no field does the question of proper depreciation policy have such practical importance as in the public utility group. Yet nowhere have there been wider variations in both theory and practice. Some years ago there were instances, notably that of Cities Service Company, of complete failure to make any deduction for depreciation and depletion in the annual reports, with a resultant gross misstatement of the earnings for the stock. The argument has often been advanced that depreciation charges may properly be ignored because they are mere bookkeeping entries and do not represent a real outlay of cash. This is a highly inaccurate statement of the case. Depreciation is not a mere bookkeeping conception because, for the most part, it registers an actual diminution of capital values, for which adequate provision must be made if creditors or owners are to avoid deceiving themselves. Moreover, in the majority of cases, the depreciation charges are consumed or offset over a period of time by even larger cash expenditures made for replacements or extensions. More often than not, therefore, depreciation charges are eventually found to be related to actual cash outlays and turn out to be as truly an expense of the business as wages or rents. Minority cases are fairly numerous in which a good part of the depreciation reserve remains unexpended over a long period of time. In these instances, a reduction of the annual charges may sometimes be justified in the investor's calculations, as we shall later explain. The broad principle remains, however, that an adequate depreciation allowance is essential in arriving at a fair statement of earnings. Other misleading practices. Another fairly prevalent practice was the deduction of only part of the depreciation charge from earnings, the balance being taken out of the surplus account. In some instances, the amounts charged to income were based on the so-called indenture minima, a percentage of gross earnings for maintenance and depreciation combined required to be deducted under the terms of a bond issue. When these indenture minima were less than the depreciation actually needed and taken, we find that requirements ostensibly set up for the protection of investors were actually used to mislead them. It is unfortunate that something resembling this practice has been resorted to at times by conservatively managed companies. An example may be found in the accompanying PDF regarding the reports of the Detroit Edison Company for 1931 and 1930. Although Detroit Edison's depreciation charges have been unusually liberal by comparison with the average for the industry, the accounting method employed for 1931 and also in 1934 might well be criticized for two reasons. In the first place, its effect, if not its purpose, was to disguise the actual decline in earnings from the previous year. Secondly, because of the high reputation of the company, this device was likely to be imitated by other enterprises, and thus it might furnish an unwholesome stimulus to the new practice of overstating earnings by the transfer of charges to the surplus account. An illustration of tricky accounting. An extraordinary example of tricky accounting is displayed by Iowa Public Service Company. For 1929, this company reported a property account of $25,200,000, gross earnings of $4,200,000, and a depreciation charge of only $78,000. The inadequacy of this figure is patent. In succeeding years, the depreciation allowance was gradually increased, reaching $220,000 in 1932, which was still a somewhat subnormal figure. In 1932, the company made formal confession of the insufficiency of its past depreciation charges by the following unique procedure. 1. It reduced the stated value of its common stock by $1,587,000 and transferred this sum to capital surplus. 2. It immediately used up this capital surplus by charging against it $1,500,000 for additional depreciation and $87,000 for contingencies. In this case, we see a good part of the necessary depreciation charge excluded from the income statements over a period of years, and finally allowed for by reducing the amount at which the common stock is valued. An incidental effect of this mischievous accounting was to permit the parent company, American Electric Power Corporation, to take out in dividends a sum exceeding the true earnings and the initial surplus combined, to the serious prejudice of the bondholders and the first preferred stockholders. Inadequate depreciation revealed by transfers from surplus and reserves. Example. The case of Brooklyn Union Gas is perhaps the most impressive example of the failure of the income account to reflect the necessary deductions for amortization. The extent of the consequent overstatement of earnings has been glaringly revealed by the huge transfers required to be made from surplus and contingency reserves. The story as regards the 10 years 1929 to 1938 may be found in the accompanying PDF. The figures found in the PDF are given in considerable detail since they disclose a complicated but significant state of affairs bearing on the true earning power of the company. The reader will note the following points. 1. The average reported earnings of $5.13 per share were computed after deduction of a retirement reserve of very small size in relation to both gross earnings and plant account. 2. These charges for retirements against income proved woefully inadequate to cover the actual retirements taking place during the period. To meet these charges, the company had to exhaust a large contingency reserve. 3. Although the company reported to stockholders that it had earned an aggregate of $51 per share during the period, paid dividends of $40 and carried $11 per share to surplus, its surplus and contingency reserve had really decreased about $26 per share. Hence, the earnings, as indicated by the balance sheet, had averaged only $1.36 per share instead of $5.13 per share as reported in the income account, $13,800,000 at the end of 1928, and to draw heavily on surplus besides. 4. The actual retirements of property during this period averaged $2,688,000 per annum, or 11% of gross, as compared with the charge to income of $729,000, or 3.1% of gross. In the year 1938, the company stated that, in accordance with the new requirements of the Public Service Commission of New York, it was adopting a depreciation policy, that the details had not yet been worked out, and that provisionally it was charging $1,200,000 per annum for the purpose. Judging from the facts stated in our previous discussion, there would seem to be grounds for doubt if even this amount, although much larger than former charges, is adequate. A variety of depreciation policies. The foregoing discussion of failure to reflect full depreciation charges in the income account leads us into a broader topic, viz., the basis used by a company in making its depreciation allowance. The methods employed reveal an extraordinary variety, no less than 7 calling for description as follows. A. Depredation proper. 1. Straight line method. Each class of depreciable property is written down to salvage value by equal annual charges during the period of its estimated life. This is the standard method of calculating depreciation permitted by the Revenue Acts and generally followed by all companies in their income tax returns. Surprisingly few electric and gas companies, however, have employed this method in their published income accounts. Example, Union Electric Company of Missouri, a subsidiary of North American Company, has used this straight-line method for a number of years. But even here, the company's reported allowance is less than that claimed on its income tax return, $3,899,205 versus $5,549,109 in 1937. The difference being due apparently to assuming a shorter life for tax purposes than for annual report purposes. As will be pointed out later, recent regulations adopted by state commissions and by the Federal Power Commission are now necessitating a changeover by many companies to the straight line or standard method in their reported earnings. 2. Sinking fund method. Allowance is here made for the fact that amounts set aside for depreciation will earn interest until the property is retired. The effect of this method is to make the deductions somewhat smaller in the earlier years and correspondingly higher in the later years. It is generally used by California utility corporations under agreements with the Railroad Commission of the state, the rate of interest allowed being 6%. Examples, Pacific Gas and Electric, San Diego Consolidated Gas and Electric. Even here, the companies take the straight-line basis in their tax returns. 3. The overall method. This applies a single annual percentage to the entire depreciable property account instead of varying rates to different classes of assets. The object, presumably, is to arrive at a simple approximation of the actual depreciation. Example, Commonwealth Edison deducts 3% of the average book value of depreciable property. B. Retirement reserve methods. The distinguishing feature of a retirement reserve is that it does not seek to measure the depreciation during a given period caused by wear and tear or obsolescence. Instead, it is supposed to provide funds that, in the opinion of the management, will be adequate to take care of retirements of property when and as they occur. Over any long period of time, proper depreciation and proper retirement allowances should total the same amount. But a retirement reserve policy apparently permits arbitrary annual variations to reflect good or bad earnings or the expected near-term need for actual retirements. In reality, as will be seen, the majority of retirement reserve policies operate simply to understate the current loss of property value and thus to overstate the earnings. Various bases of calculating retirement reserves are as follows. 4. Percentage of gross. This method would tend to approximate a regular depreciation rate if the percentage taken were adequate. Generally, this is not the case. Example, Duquesne Lighting Company deducts 8% of gross. On the other hand, its income tax deduction for 1932 to 1934 equaled no less than 30% of gross. 5. Fixed rate per unit of product. This method clearly resembles the preceding and is subject to the same criticism. Examples, In 1932, Brooklyn Union Gas Company stated that it was reserving 3 cents per 1,000 cubic feet for retirements. This policy has since been changed. Cincinnati Gas and Electric Company stated in 1937 that it was making provision for retirement reserve at the rate of 5 cents per 1,000 cubic feet of gas sold and $2.70 per 1,000 kilowatt hours of electricity sold. 6. Overall percentage of gross for maintenance and depreciation combined. By this method, the larger the amount spent for maintenance, the less is reserved for depreciation. Examples: Third Avenue Railway used a 20% deduction for maintenance and depreciation combined for the years 1912 to 1918. Tidewater Power Company uses varying total rates for different services, viz., in 1936, gas and electric 15%, water 12%, railway 30%. 7. Discretionary deductions. The majority of companies following the retirement reserve method have been bound by no mathematical formula, but have based the annual deduction largely on the judgment of the management. Examples: A. Amounts varying year by year. Detroit Edison, Philadelphia Electric, American Waterworks and Electric, American Power and Light. B. Unchanged annual round amount. Tampa Electric charged $430,000 per annum from 1933 through 1939. C. Allowance made equal to actual retirements during year. Western Union Telegraph Company in 1932 to 1936. The depreciation charge of $5,631,000 in its income account for 1936 compares with a provision of $11,190,000 in the tax return. The difference would account for most of the $7,199,000 reported as earned for the common stock that year. The inadequacy of past allowances for depreciation was shown by the transfer in 1937 of $30 million from surplus to depreciation reserve. Double accounting policies on depreciation. We have already stated that, regardless of what method is followed in the annual reports, practically every company follows the straight-line basis of depreciation in computing its income tax. The investor is thus confronted with a dual situation and a pressing problem. In many cases, it is of vital importance to know which basis of depreciation is correct, since bond interest coverage and common stock earnings which may appear adequate, as reported in the company's annual statements, would turn out to be entirely insufficient if the income tax figures are accepted. Example: the existence of this disparity was unknown to investors generally until brought out into the open in one of the first prospectuses published under the terms of the 1933 Act, viz., that describing the American Waterworks and Electric Company Convertible Fives, due 1944. This document revealed that in 1932, tax return amortization had been taken at $7,023,000 as against income account amortization of only $2,747,000. At that time, there was a tendency in Wall Street to minimize the significance of these divergences on the ground that depreciation was a highly technical and controversial matter, and there was just as much reason to accept the income account basis as the tax return basis. Reasons for accepting, in general, the income tax base. We have always been convinced that this heedlessness was dangerously unsound. Developments since 1934 have strongly buttressed our opinion, so that we now can advance no less than 5 major reasons for accepting, in general, the income tax figure rather than the income account basis of depreciation. These are: 1. The straight-line basis follows a definite and logical accounting theory. If it resulted in an excessive deduction, the Treasury Department would not accept it. The various retirement reserve bases are either entirely arbitrary or technically unsound. 2. The inadequacy of the retirement reserve idea in general has been shown by the necessity in many cases of making large transfers from surplus to bolster the retirement account. 3. Since 1934, there has been an almost universal increase in the retirement allowances, both absolutely and percentage-wise. This may be considered a virtual confession of past inadequacy. The extent of these increases is indicated by our table on page 474, which may be found in the accompanying PDF, which supplies information concerning depreciation or retirement allowances, as well as maintenance charges covering the years 1930 and 1938 for a number of utility companies. It is to be noted that in the earlier year, the companies using the retirement basis generally made lower charges than those using the depreciation basis. Observe also that a number of the companies previously using the retirement method have since switched to a depreciation basis. Moreover, a considerable number of the companies that used the retirement basis in 1938 were on the verge of a transfer to a depreciation basis under the impetus of requirements of the Federal Power Commission and of various state commissions. 4. A number of state commissions and the Federal Power Commission have now ordered companies within their jurisdictions to follow a regular depreciation basis in all their accounts. Example: Pennsylvania, Michigan, and New York. Some important companies are perforce switching over to the income tax basis in their annual statements. For example, Consolidated Edison Company of New York for the calendar year 1938 charged $18,829,000 for retirement reserve in its report to shareholders and charged about $26,800,000 for depreciation on a straight-line basis in its income tax return. For the 12 months ending September 30, 1939, the company charged $24,217,000 for depreciation in its interim report to shareholders, as against a charge of only $17,737,000 in its report for the corresponding period ending September 30, 1938. Gross operating revenues for the latter two periods were $248,666,000 and $239,413,000 respectively. 5. Where any real alternative exists, the investor in fixed value securities must invariably apply the more stringent test of soundness. A comparative depreciation or retirement allowances of public utilities 1930 and 1938 may be found in the accompanying PDF. It is difficult to understand from these figures how the investor could justify to himself the purchase of Pennsylvania Power and Light $5 preferred at a price to yield only 5.26%. On the basis of the company's own report, the margin above fixed charges and preferred dividends was entirely inadequate. On the income tax basis for depreciation, this is cut by more than half. On the basis of the percentage of gross applied by Southern California Edison, the margin practically disappears. If we examine a very similar situation existing in 1930, we shall see how important it was for the investor to recognize the implication of the figures. In this case, we had three factors that militated against the investment merit of American Power and Light preferred stock. 1. The coverage as stated was entirely insufficient for real safety. 2. The depreciation rate taken was far too low. An adjustment to the Pacific Lighting basis would have sharply reduced the margin above preferred requirements. 3. These requirements were temporarily understated by about $2 million because a large preferred issue was then entitled to only $3 in dividends, the rate advancing gradually to $5 in 1933. The decline in the market price of the $6 preferred in 1988 was due to reductions in the dividend beginning in 1933, brought about in turn by lower net earnings which absorbed the small margin above preferred requirements existing in 1929. Recovery in reported earnings after 1933 was held back, in part, by the necessity of stepping up the depreciation allowance gradually to bring it in line with realities. Instances when income tax basis should be rejected or questioned. The reader may note that we have counseled acceptance of the income tax basis in general. The suggestion is qualified because there may at times be reasons either to accept the annual report figures or even to seek a third basis of amortization. The Pacific Lighting case used for comparison in the last example illustrates our first exception. The figures for 1929 were taken from the annual report and are based on the sinking fund depreciation method generally followed by agreement between the California Commission and California utility companies. It appears that the deductions for depreciation taken by the company average lower than the straight-line deduction taken on the tax returns. Nevertheless, in this case, the company's reported figures might well be accepted, first, because they result from applying an admissible accounting method, and second, because the amounts appear to be liberal in relation both to the property account and to the gross earnings. The same reasoning would apply to all the California utilities. There is another large group of companies that have taken depreciation allowances that appear liberal in themselves, but are still substantially less than the income tax deductions. Examples. In 1938, Detroit Edison charged 13.5% of gross on its report to shareholders versus 18.2% of gross on its tax return for that year. Corresponding figures for North American Company for 1937 were 12.8% and 14.8% respectively. In these instances, the investor, and particularly the common stock buyer, may argue that the income tax basis is unduly severe. It is difficult to pronounce judgment on this point in the absence of detailed knowledge of the properties themselves and a better familiarity with public utility engineering details than we possess. We are inclined to advance the compromise suggestion that when the tax figure exceeds, say, 12.5% of gross, the latter rate be used provisionally for purposes of analysis. It may be pointed out that several years ago it appeared that 10 to 12% of gross constituted a comparatively liberal deduction. Practical effect of varying depreciation policies. The reader may consider this discussion of utility depreciation policies to be highly technical and uninteresting, but the fact remains that it has a bearing of the greatest practical importance on the selection of public utility stocks and on their market behavior. The companies that charged inadequate depreciation prior to 1934 were generally overvalued in the stock market because investors gave equally inadequate attention to this point. A careful analyst would have found many occasions to suggest transfers from less conservative to more conservative companies. Since in the following years there has been a tendency for the former group to step up their charges substantially, their reported earnings have been correspondingly held down, and their market prices also. The following example that may be found in the accompanying PDF illustrates this development. The price of American Water Works common in 1933 was apparently based on the reported earnings for previous years, without allowance for the fact that the retirement allowance was definitely inadequate. A good part of the decline in the amount available for the common 7 years later was due to the necessity for increasing the retirement allowance in line with the general tendency. The Pacific Gas and Electric exhibit is appended to demonstrate that the public utility stock buyer could have obtained much more for his money in 1933 had he been willing to scrutinize depreciation policies with care. Chapter 36. Amortization charges from the investor's standpoint. We have already made several references to the point that a depreciation or depletion charge that is technically proper from the accounting standpoint may fail to reflect the situation properly as it concerns the buyer of the company's stock at a given price. Problem indicated by hypothetical example. The point at issue may be more readily comprehended by the use at the outset of a simplified and therefore hypothetical example. Let us assume that companies A, B, and C are all engaged in the trucking business. Each has a single truck. Each is capitalized at 100 shares of stock, no par, and each earns $2,000 per annum before depreciation. Company A paid $10,000 for its truck. Company B paid $5,000 for its truck. Company C paid $5,000 for its truck, but followed an ultra-conservative policy and wrote its value down to $1. Assume that A's purchase of a dearer truck was an accident, and that in fact the managements of the three companies are equally capable and their general situation identical. The accountants give these trucks a depreciable life of 4 years. On this basis, the income accounts of the three corporations are as follows. Net before depreciation. Company A, $2,000. Company B, $2,000. Company C, $2,000. Depreciation at 25%. Company A, $2,500. Company B, $1,250. Company C, $0. Balance for common stock. Company A, $500 deficit. Company B, $750. Company C, $2,000. Earned per share, Company A, 0. Company B, $7.50. Company C, $20. Typical market appraisals. According to these audited statements, A is losing money, B is earning 15% on its capital, and C is doing very well indeed. An investor steeped in the recent wisdom of stock exchange valuations would consider the shares of Company A practically worthless, $5 per share perhaps being a generous appraisal. On the other hand, he might value the shares of B and C at about 10 times the earnings, which would produce $75 per share for B stock and no less than $200 per share for C stock. Such a procedure would result in the following total valuations for the three enterprises. Company A, $500. Company B, $7,500. Company C, $20,000. The absurdity of these valuations should be too patent for argument. Nevertheless, they represent merely a faithful application of current accounting methods and the established Wall Street reasoning. The results are, first, that a company with a less valuable asset is, for that very reason, declared to be worth more than a company with a more valuable asset. And, second, that by the single gesture of writing down its assets to zero, a company has been able to increase enormously the market price of its shares. Irrationality of these valuations disclosed by the balance sheet. The irrationality of these conclusions would be even more glaring if the balance sheets are examined. Assume that the companies have been in business 3 years and, for simplicity, that they started with no working capital. Company A, having lost money steadily, has of course paid no dividends. Company B has paid out 2/3 of its earnings, that is, $5 per share annually, and Company C has paid out 3/4 of its profits, or $15 per share. The balance sheets would then read as shown in the table on page 481, which may be found in the accompanying PDF. Although Company A has a profit and loss deficit, it has accumulated the largest amount of cash, presumably earmarked as a depreciation fund. Company C, which has shown the largest earnings, has by far the smallest cash holdings. The suggested market value of $5 per share for Company A would amount to only 1/12 of its cash, whereas the price of $200 for Company C shares would equal more than 12 times the cash behind them. A more rational approach. These are the Alice in Wonderland results to which the accepted logic of the stock market would lead us. Let us now ask a more sensible question, viz., how would a businessman determine the reasonable value of these three enterprises? Common sense would tell him immediately that all three businesses, as such, independent of their assets, are of equal value. As a practical business matter, he would be inclined to place a somewhat higher valuation on the more expensive vehicle owned by Company A than upon the cheaper truck of Companies B and C. Nor is there the slightest doubt that this businessman will give full weight to the relative cash holdings of each company. His reasoning would therefore run somewhat as follows. Each business is worth, in the first instance, the amount of its cash plus the fair market value of its truck. Something might properly be paid also for the goodwill because the earnings on the average capital required for the business, after allowing for necessary depreciation, would be quite substantial. This goodwill value would be the same for all three enterprises. What is the relation of the company's depreciation charges to these valuations? The answer is that the charge made by Company B might well be accepted as relevant because it corresponds fairly well with the conditions of the business. Partly by coincidence, this fact results in making the businessman's valuation of Company B identical with that reached by the Wall Street method. But in the case of Company A and Company C, the depreciation charges made by the managements are entirely out of line with the realities of the business. In the one case, they have been made far too high because of the excessive cost of the fixed assets. Such an error should be corrected by writing down the property account and the capital account to a fair going value against which a business-like depreciation charge will accrue. In the case of Company C, the assets have been deliberately undervalued for the purpose of suppressing a depreciation charge that must be allowed for out of earnings because the owner's investment is actually depreciating. If the businessman or the investor is going to pay anything for the truck or for the business itself that requires a truck, he cannot avoid allowing for depreciation on the amount so paid by merely making believe that there is no such investment. Practical application of foregoing reasoning. Let us consider now how the foregoing reasoning may be applied to actual situations that confront the security buyer. Examples. As an initial example, we shall present the exhibit of the Eureka Pipeline Company for the 3 years 1924 to 1926. This may be found in the accompanying PDF. The final column would imply that during the 3 years under review there was practically no earning power for the shares, so that presumably the stock would have no value on a going concern basis. But would such a conclusion be justified from a business standpoint? The question will turn, as in our hypothetical examples, upon the correctness of the depreciation charges. The following data, also found in the accompanying PDF, will throw additional light upon this aspect of the Eureka Pipeline's record, figures in thousands. We find that the expenditures on property account averaged only $73,000 per annum, so that there was available in actual cash the sum of $368,000 per annum to be added to working capital or used for dividends, which were charged against previously accumulated surplus. It is clear that this business had been a producer of cash income for the owners, and for that reason it had substantial going concern value, although the high depreciation charges made it appear that there was none. How to determine the proper depreciation charge? In this case, therefore, as in our hypothetical example, the investor or the analyst must reject the company's basis for depreciation and endeavor to establish some other basis more consonant with the actual conditions of the business. How can the proper charge be determined? The answer was given without difficulty for the trucking companies because we knew just what depreciation had to be allowed for in order to maintain these enterprises in operation. But in practice, such exact knowledge is hardly ever available. We do not know how long the Eureka Pipeline's fixed assets will last or how much it would cost to replace them. The best we can do is formulate some rough estimates based on the discoverable facts. The only virtue of these estimates may be that they are, in all probability, closer to the mark than the company's figures, which we realize are untenable. Concept of expended depreciation. Taking a business attitude towards the Eureka Pipeline's exhibit, it is evident at the start that the depreciation allowance should be not less than the average expenditures made on the property. The primary reason for reducing the company's depreciation charges is that they do not properly reflect the cash available from operations. The expenditures on property account, including new fixed assets, represent, in effect, the portion of the depreciation reserve that is not available in cash, and that portion should hence be considered as the minimum amount of depreciation that must be allowed for in conducting the business. We may call this item the expended depreciation charge. If the increase in the property account exceeds the year's depreciation, then all of the latter must be considered as expended. In the case of Eureka Pipeline, such expenditures averaged $73,000 for the 3 years 1924 to 1926. This period is much too short upon which to base conclusions, but it happens that about the same results are shown by Eureka over a much longer period, so that the 1924 to 1926 figure may here be used as a basis of calculation. We must warn the student against deriving any notion as to the normal expended depreciation from examination of a short period, for example, less than 10 years, unless he knows that the nature of the business is such as to warrant a conclusion therefrom. Long-term depreciation, a form of obsolescence. The second question is what amount should be provided as a reserve to take care of the eventual wearing out of the entire property. In other words, for the major replacements that may have to be made at some distant date. This is the leading function of the depreciation charge in most theoretical discussions of the subject, and our trucking company examples were based on a simple application of this idea, the total fixed asset account having to be replaced at the end of 4 years. But we must recognize that in practice, such complete wearing out and replacement are of exceedingly rare occurrence. The typical corporation does not accumulate a large cash fund over a stretch of years, which is finally employed to replace the plant in its entirety at the end of its useful life. Factories do not actually wear out. They become obsolete. In 9 cases out of 10, plants are given up because of changes in the character of the industry, or in the status of the corporation, or in the locality where the plant is situated, or for other reasons not related to actual depreciation. These developments represent business hazards, the extent of which is not susceptible of any engineering or accounting measurement. Stated differently, the long-term depreciation factor is in reality overshadowed and absorbed by the obsolescence hazard. This risk is essentially an investment problem and not an accounting problem. It should not operate to reduce the earnings, as does a depreciation charge, but rather to reduce the price to be paid for an earning power subject to such a business risk. Application of foregoing in determining earning power. Let us endeavor to relate these conclusions to the Eureka Pipeline example. The expended depreciation charge has been found to average about $75,000 per annum. There are no indications that the entire plant will have to be replaced at any predictable date. On the contrary, the line appears to have an indefinite life due to continuous expenditures on maintenance, repairs, and renewals. In this respect, the enterprise resembles a railroad far more than it does a trucking company. According to our reasoning, only the expended depreciation charge should be deducted from earnings. The remainder of the depreciation factor is actually the obsolescence hazard, which is related to the possible exhaustion of the tributary oil fields. This should be considered after the earnings are arrived at and not before. A proper statement of the case would appear as follows. Eureka Pipeline, 1924 to 1926 basis. Item: earnings before depreciation. Total $442,000. Per share $8.84. Expended depreciation charge estimated $75,000 total, $1.50 per share. Balance: earning power subject to business hazards including obsolescence, $367,000 total, $7.34 per share. Problem of valuing the earning power. The company's figures showed no earning power for the period. Our figures show an earning power of over $7 per share, which clearly indicates substantial value for the enterprise. The price that may properly be paid for this earning power is subject to whatever considerations enter into buying a going business. This includes, on the one hand, the possibilities of increased profit and, on the other hand, all the multitudinous risks of loss, of which obsolescence of the fixed assets is only one. If, for example, it seemed conservative to require earnings of 20% on the investment to cover these hazards adequately, then the indicated value of Eureka Pipeline stock on the above showing would be about $35 per share. A detailed discussion of this point must be postponed, however, until we reach the topic of valuation of common stocks. For the purpose of this chapter, it should suffice to point out that in the actual case of Eureka Pipeline, as in the hypothetical case of Trucking Company A, it was both necessary and feasible for the investor to establish a depreciation allowance significantly different from that employed by the company itself. Depreciation on apartment and office buildings. In actual investment practice, the foregoing reasoning finds its widest application in the field of real estate securities. What is the true function of the depreciation charge in the analysis of the numerous bond issues secured by a lien on apartments or office buildings? Clearly, the deduction for depreciation is an accounting rather than an investment calculation. It is based on the assumption that the original cost is being used up by wear and tear in equal morsels over, typically, a 50-year period. But it would be an extremely rare coincidence for this arithmetic to correspond to the investment facts. Buildings of steel and stone do not actually wear out in 50 years. They become obsolete and are torn down after a life that depends for its length not on wear and tear but on real estate conditions. Furthermore, in the case of the huge number of real estate bonds that can be bought at large discounts from face value, the investor's write-off for both depreciation and obsolescence would be based on a cost to him much lower than the book value, which is subject to the conventional depreciation. The concept of expended depreciation may be useful in this field because the average expenditures for replacements must be considered as the equivalent of a cash operating expense. Parenthetically, it may be pointed out that this is an important factor in the analysis of hotel bonds. But it is even more important to warn the investor that hotel bonds should be viewed as obligations of a special type of business enterprise and not as a form of real estate security. Example: a brief analysis of the first mortgage bonds of 1088 Park Avenue Corporation, owning a large apartment building in New York City, will illustrate the points that we have been making. There are $1,851,000 of this issue outstanding, bearing fixed interest of 2 3/4% and contingent interest, depending on the amount of bonds retired, up to 2 1/4% additional. All of the stock of the corporation is attached to the bond issue. The average price in 1939 was about $35. Total market value of all securities, $653,000. Accounting details may be found in the accompanying PDF. Our analysis would suggest the following. 1. Assuming that 1938 revenues and expenditures are representative of the future and also that the reserve for capital expenditures made in that year is representative, there would be an indicated cash income for the bonds of $84,600 less $7,000, or $77,600. This would be 4.3% of par and 11.9% of the market price. 2. This percentage must be taken not only as applicable to a return on the investment, but also as an allowance for the obsolescence accruing against the building, which was constructed in 1925. But this obsolescence is governed not only by age, but also by changes in character of neighborhood, building styles, etc., factors that are almost indistinguishable from general business risks. 3. The investor may assume that out of the ample cash income he will receive fixed interest of 2 3/4% of par, or 7.86% of the market price. The balance, amounting to 4% of the market price, will be used by the company partly as a sinking fund to reduce the bond issue and partly for additional interest. What this really means is that the loss of value through obsolescence will be offset by cutting down the debt. The investor's judgment must decide whether or not A, the interest return is attractive as compared with the chances both of higher and lower net earnings, and B. The sinking fund operations will amply take care of the obsolescence factor. If his answer is decidedly yes, he would be warranted in regarding the issue as an attractive investment, not in spite of its low price, but because of its low price. 4. There is the possibility that obsolescence may be offset by appreciation due to a rise in real estate values, cyclical, secular, or inflationary. Reliance on such appreciation in the past has led many investors to ignore depreciation and obsolescence in their real estate purchases. We suggest that such possibilities must be viewed as speculative, that they do not cancel obsolescence but merely offer an offsetting attraction, and that an investment commitment in the bonds must be justified without including any such rosy expectation. Inadequate allowances for depreciation. Let us now consider examples involving the opposite type of situation, viz., the use of accounting methods by corporations that give rise to inadequate allowances for depreciation. Particular attention must be given to the vogue for drastic write-offs of fixed assets for the admitted purposes of reducing the depreciation charges and thereby increasing the reported earnings. This practice had its inception during the 1927 to 1929 boom, but its widest development took place in the ensuing Depression. Two typical cases are selected for discussion. Effect of writing down fixed assets. Unit, $1,000. Examples. Early in 1933, the United States Industrial Alcohol Company and the Safety Car Heating and Lighting Company announced plans under which the property account was written down to a net value of $1 by means of a corresponding reduction in stated capital and surplus. The transactions may be summarized in the condensed balance sheets shown in the table that may be found in the accompanying PDF. The United States Industrial Alcohol revision was accompanied by a statement to the effect that, by reducing the book value of fixed assets to $1, the necessity for future charges for depreciation would be eliminated. It was proposed, however, to set up a reserve for replacements account by charges against income of amounts deemed sufficient to provide for the replacement of productive facilities. It was believed that for 1933, an adequate amount of such charge would be $300,000, which might be compared with approximately $900,000 charged against income for depreciation in 1932. The safety car announcement carried the idea even further. No provision for depreciation was made in 1932, so that a net profit was reported for that year against a loss for 1931, although income before depreciation was smaller in 1932. It was stated in the annual report of the company for 1932 that, by the elimination of depreciation on fixed assets as of December 31, 1932, all profits above operating expense and depreciation on subsequently acquired capital assets could be considered by your directors for distribution to the stockholders without any decrease in the company's current assets. Earnings manufactured from depreciation account. The procedure followed by Safety Car is identical with that of our imaginary trucking company C, which wrote down its truck to $1 and thereby avoided charging depreciation to earnings. We have already pointed out that if depreciation must be allowed for in fact, it cannot be eliminated by bookkeeping entries. The safety car stockholder does not earn $1 more on his investment because his fixed assets have been written down to nothing. Nor can necessary expenditures for plant upkeep or replacement be in any way reduced by making believe that there no longer is any plant. Let us examine the safety car heating and lighting exhibit in somewhat the same manner as that of Eureka Pipeline. Over a 10-year period, the expended depreciation charge averaged about $500,000 per annum. The earnings record for the decade is approximately as shown in the table found in the accompanying PDF. If this company were analyzed amid the uncertainties of 1933, it would be impossible to determine whether the long-term or the recent figures are a better guide to the future. But whatever assumption is made on this score, it is quite clear that a depreciation charge must be allowed for. If no better than the 1932 results can be expected, then a very small earning power at best would be indicated, since actual expenditures on plant will no doubt come close to, if they do not exceed, the reported earnings of $233,000. If by any chance the profits should return to their 10-year average, the complete elimination of the former depreciation charge would result in a serious overstatement of the true earning power. Sequel, 1933 to 1938. During this period, the company reported average earnings of $590,000 or $6 per share, after charging average depreciation of only $18,000. Had the 1922 to 1931 basis of depreciation been maintained, there would have been no earnings per share for the 6-year period and a substantial profit only in the year 1937. In that year, the earnings, as reported, reached $19.72 per share, and the price rose to $141, only to fall as low as $48 in 1938. The advance in 1937 might be ascribed to a twofold miscalculation of the market by, 1, considering the large volume of air conditioning installation done in that year as if it were fully recurring, and 2, ignoring the necessity for a depreciation charge substantially higher than the company's meaningless figure if such a volume were to continue. The United States Industrial Alcohol Company write-off did not result in the complete elimination of depreciation charges against earnings, but in lieu thereof it was proposed to set up a replacement reserve to be determined arbitrarily by the directors. For 1933, the amount was fixed at $300,000. A study of the approximate figures for the preceding 5 years would warrant grave doubts as to the adequacy of such a charge for replacements under normal conditions. In this case, the net plant account, gross plant less depreciation, increased $500,000 during the 5-year period. That is, from $18,800,000 at the end of 1927 to $19,300,000 at the end of 1932. In other words, the money spent for property extensions and replacements somewhat exceeded the total depreciation allowance of $6,750,000. This development is characteristic of most of our large corporations, which tend to add to their facilities as the years pass. In all such cases, it must be assumed that the depreciation charges, based upon accepted accounting rules, are the minimum necessary for properly reflecting the conditions of the business. They cannot soundly be reduced either by the corporation through arbitrary write-downs or by the investor in his individual calculations. Hence, if the United States Industrial Alcohol Company should regain its former profit-making ability, a drastic reduction of the former depreciation reserves would in all probability result in a misleading overstatement of the true earning power. Other examples of elimination of fixed assets. Commercial Solvents Company wrote down its plant account to $1 in 1932. May Department Stores and Kaufman Department Stores both wrote down their furniture and fixtures account to $1 in 1933 and 1929 respectively. Park and Tilford Company wrote down its machinery and fixtures account to $1 in 1927. In all these cases, subsequent depreciation charges were reduced to less than a suitable figure. Stock watering reversed. The new policy of writing off fixed assets bears an interesting relationship to the recent conceptions of stock values. It is a direct outgrowth of the ignoring of asset values and the monopolizing of attention by the reported per-share earnings. A generation ago, when investors consulted balance sheets to ascertain the net worth behind their shares, this net worth was artificially inflated by writing up the book value of the fixed assets far above their actual cost. This in turn permitted a corresponding overstatement of the capitalization at par. Stock watering, as this practice was called, constituted at that time one of the most severely criticized abuses of Wall Street. It is a striking commentary on the change in our financial viewpoint that the term stock watering has practically disappeared from the investor's vocabulary. By a strange paradox, the same misleading results that were obtained prior to 1914 by overstating property values are now sought by the opposite stratagem of understating these assets. Erase the plant account, thereby eliminate the depreciation charge, thereby increase the reported earnings, thereby enhance the value of the stock. The idea that such sleight of hand could actually add to the value of a security is nothing short of preposterous. Yet Wall Street solemnly accepts this topsy-turvy reasoning, and corporate managements are naturally not disinclined to improve their showing by so simple a maneuver. Purchasers' amortization of ore reserves. The distinction between the company's and the investor's allowance for amortization appears most clearly in cases involving depletion of ore reserves. As pointed out in Chapter 34, the amounts charged off by a mining company for depletion are based upon certain technical considerations which are likely to be quite irrelevant to the stockholder's situation. Example: in the table on page 494 found in the accompanying PDF, a study of the showing of Homestake Mining Company for the year 1925 and again for 1938 will illustrate this point. Superficially, the price of 63 early in 1939 would seem to be somewhat better justified by the past year's earnings than the price of 50 in early 1926. But the reported earnings were based upon the company's charges for depreciation and depletion, which bear no relation to the price which the purchaser of the shares is actually paying for the mine. It will again be helpful to view the picture from the standpoint of a businessman considering the purchase of the entire enterprise at the valuations indicated by the market price of the stock. In 1926, the valuation would be $12,500,000. For this sum, he would obtain about $2,500,000 in current assets, equivalent to cash, so that the mine and plant would cost him only $10 million. It is this capital investment which he would have to amortize, that is, recover out of earnings, together with a suitable profit before the mine is exhausted. In 1926, the developed ore reserves indicated a minimum life of 11 years for the property at the current rate of production. Since new ore had continuously been developed in amounts very nearly equal to the tonnage mined, there was good reason to expect a life considerably longer than the minimum figure. It would not be conservative, however, to count on more than 20 years. In a mining venture of this type, the same amortization rate should ordinarily be applied to the machinery and other equipment as to the mine proper, on the theory that the plant will last as long as the mine and will then have to be scrapped. Homestake Mining Company. The purchaser's amortization calculation. The purchaser's amortization rate would therefore have to be somewhere between 5 and 9% annually on his $10 million cost price for the mine. How this would work out is shown in the table on page 495, found in the accompanying PDF, which includes a corresponding analysis of the March 1939 situation. The same maximum and minimum figures for expected life are used in both cases because the reported ore reserves continued to show a life of at least 11 years. Huiataki Mining Company buys amortization calculation. From the business standpoint, the showing for 1925, assuming it could be expected to continue, would indicate a satisfactory return on the investment at $50 per share. This is by no means true so far as the available facts are concerned. When dealing with the 1938 earnings and the related price of about 63, the company's amortization charges for 1925 were considerably higher than required by a purchase of the shares at 50. But on the other hand, the buyer at 63 could not be at all sure that the company's charges for 1938, even though increased over 1925, would be adequate to amortize his investment. In the more frequent case where a mining company's charge for depletion is not shown in its report, the same general approach must be used in attempting an analysis. This means that where the life of a property is limited, the stated depreciation charge should also be ignored and the investor's amortization charged against the earnings before depreciation. The three factors to be considered are: 1. The price paid for the mining property, total price less cash assets; 2. The earnings before depreciation and depletion; and 3. The minimum life of the mine and, alternatively, its probable life. Purchaser's amortization of oil reserves. The application of this principle to the oil industry is shown most readily by selecting a company such as Texas Gulf Producing Company, which is solely a producing enterprise and has clearly stated the oil reserves on which the purchase of the stock must be based. It is true, of course, that the company's undeveloped leases may turn out to possess important additional quantities of oil, but that would be true of any large lease holdings and cannot give them for the present any more than the nominal value represented by the cost of acquisition. Example: Texas Gulf Producing Company in 1937. 1. The situation. The significant facts relative to this company's amortization charges are relatively simple. The company is a producing enterprise solely. Most of its oil comes from a single field in Texas. Its depreciation and depletion charge per barrel is found by dividing the estimated remaining oil reserves into the net value of the properties on the books. In 1937, the oil reserves averaged about 26 million barrels, and the net property account about 9.5 millions, resulting in an amortization charge of $36.05 per barrel, or $689,000 for the year's production. Of this amount, however, only $397,000 was charged to earnings, the remainder being deducted from surplus arising from appraisal on the balance sheet. Earnings per share equaled $1.13 per share before amortization, 68 cents per share as reported, on the basis of amortization charged to earnings, and only 35 cents per share after full amortization, including the portion charged to surplus. Book value of the stock was about $10 per share. The market price in 1937 ranged between 9 5/8 and 2. 2. The investor's calculation. Omitting the possibility of new discoveries or developments, a non-measurable speculative factor, the purchaser of these shares would count on about 13 years of life remaining in the properties and would therefore deduct about 8% of his purchase price for annual amortization. Hence, at the high price of 9 5/8 in 1937, his amortization would about equal the company's total charge, and thus the remaining earnings would amount to only 4% on the price paid. At the year's average price of about 5 3/4, his allowance would approximate the company's charge to earnings, and at the low price of 2, it would need only 16 cents, and hence have left an indicated annual profit of 97 cents, or about 60% on the price paid. Purchaser's amortization of patents. A large number of important manufacturing companies own patents that are carried on their books at $1 or else at their cost, which is generally a relatively small amount. It is standard accounting practice to write off such cost by equal annual charges to earnings during the life of the patent, which is 17 years from the date it is granted. But the investor's viewpoint requires an entirely different approach. The question for him is how much is he paying for the patent when he buys the stock at a given price, and it is this amount that he must write off against the subsequent earnings. General rule. A little thought will show that in the typical case, no such calculation is practicable. The investor cannot tell what part of the price of the stock represents the current valuation of the patents, for he is in no position to gauge accurately the effect of the expiration of the company's patents upon its earnings. If we take concerns like General Electric or Radio Corporation of America, we know that their patents bulk large in the picture, but only the most exhaustive investigation could give us any idea at all as to how to allocate the current market value of the enterprise as between the innumerable patents and the other very real assets. Even when the situation appears much simpler, because a single important patent is at stake, it is easy to miscalculate its true importance to the enterprise. Examples. In the case of Gillette Safety Razor Company, the expiration of the basic patents was followed unexpectedly by a number of years of largely increased earnings and by an enormous advance in the market value of the shares. The opposite development occurred in the case of American Arch Company, which supplied patented arch brick for locomotives to nearly all the railroads of the United States. Because of the technical nature of its business and its strong trade position, those identified with this company were confident that it would hold its customers after its patents expired in 1926. But immediately thereafter, competition compelled a drastic cut in prices. The earnings dwindled and the price of the stock collapsed. Our conclusion from all the foregoing must be that patents should not be valued as a quantitative factor when the investor is dealing with the ordinary manufacturing business. Patent ownership must be considered as part of the company's trade position, reflecting itself in one's general view of the future of the enterprise. It follows that the $1 valuation of patents is the soundest for the investor's purpose, that amortization of patents can be added back to earnings if the amount is substantial, and hence, if such amortization is charged to surplus instead of income, it is not necessary to correct the earnings figure. Special cases. When a company's business consists primarily in collecting royalties on a patent or group of patents, it is possible to make a more definite provision for amortizing the investment therein. It should be obvious that such provision must be related to the price paid by the investor for his interest in the patent, rather than to the company's book cost of the patent on which its own amortization charge is based. The following three examples illustrate this point, but they also emphasize a more significant factor which is present in all analyses applied to common stocks, viz., that calculations based on the present and the past can readily be upset by the unpredictable events of the future. Example A. Centrifugal Pipe Corporation in 1929. Conclusion vindicated. 1. The situation. This company controlled American and foreign patents on the de la Valde process for making metal pipe. Exclusive license to manufacture pipe under this process was given on a royalty basis to United States Cast Iron Pipe Company. The agreement extended to 1938, although the basic patents apparently expired in 1934. Various foreign licenses were also granted, expiring in 1934 to 1936. In 1929, the price of the stock varied between 4 1/4 and 13. Earnings both for 1928 and for 1924 to 1928 had been $1.05 per share on 432,000 shares before allowing for amortization of patents, which the company was taking at the annual rate of $1.72 per share. This was derived from an initial valuation of $7 million given the chief patents at the end of 1923, at which time they had 11 years to run. On this basis, the company showed a loss after amortization. 2. The investor's calculation. An analysis made in 1929 might have suggested earnings of about $1 per share for the 10 years ending with 1938, following which no additional profits could be counted on with assurance. The investor's annual amortization charges would thus vary between 43 cents and $1.30, corresponding to a purchase price between 4 1/4 and 13. Obviously, at $13 per share, there could be no earnings on the investment unless profits were greater than in the past. At $5 per share, on the other hand, the $1 estimate would yield an annual profit of 10% after allowance of 50 cents for amortization. 3. The sequel. Strangely enough, the results indicated at the beginning of 1929 were exactly realized in the following 10 years. In this period, the company earned $10 per share, of which it paid $6 in dividends. In 1939, it practically wound up its affairs by distributing $3.80 in cash plus a residual stock worth about 50 cents per share. Example B. Hazeltine Corporation in 1937. Calculation affected by new developments. 1. The situation. This company was organized in 1924 and controlled the Nutridyne patents for radio receivers, which apparently expired in 1936. Other patents were also acquired. In the ensuing 13 years, its results fluctuated widely, but it earned an average of about $2.40 per share, from which it reserved $1.50 per annum to amortize its patent account. Dividends were paid irregularly, averaging $1.70 per annum, mainly out of the reserve for amortization of patents. In 1936 alone, earnings before amortization were $3.70 per share. In 1937, the stock sold as low as $7, which was about equal to the accumulated cash assets, and as high as $18.50. 2. The investor's calculation. If the investor assumed that the company's chief revenue was derived from its Nutridyne patents, he would have concluded that the stock was too high at $18.50, since expiration of those patents in the near future would apparently severely reduce the future earning power. At $7, on the other hand, the stock could still appear cheap in view of the substantial cash assets and the prospects of some earnings from the remaining patents. Actually, this would have been a superficial analysis, since the record showed that the company controlled hundreds of patents of various sorts. Hence, nothing short of a careful inquiry into the details of Hazeltine's business would have warranted a conclusion as to the relative value of the expiring and continuing patents. 3. The sequel. The company's earnings proved to be fully as high in 1937 to 1938 as they had been in 1936. A new patent covering a coupling system used in most receiving sets was issued to it in 1938 and gave it as strong a position in the field as it formerly held. The price of the stock advanced to $30 in 1938 and to $36 in 1939. Example C. International Cigar Machinery Company in 1939. A current analysis. 1. The situation. This company's chief patents give it control over the manufacture of cigars by machine. It also owns other patents of less importance in the field. The original cigar machinery patents have apparently expired, but new improvements have maintained the company's position. Earnings have come mainly from royalties and sales of licenses. In the 10 years, 1929 to 1938, they varied between $2.08 and $3.33 per share, and amounted to $2.28 in 1938 on 600,000 shares. These figures are after relatively small depreciation and amortization charges of about 30 cents per share annually. The company's balance sheet at the end of 1938 lumped all intangibles together at $14 million gross, of which amortizable patents must have represented a relatively small amount and non-amortizable goodwill the major portion. Net working capital and other tangible assets amounted to only $2 per share. In 1939, the price of the stock ranged between 20 and 24. 2. The investor's calculation. If the company's business were thought to be largely dependent on any single set of patents, an average price of 22 could not be justified, for in that case it would be unlikely that future earnings up to the expiry of the patents would be sufficient to pay back the investment in full, plus suitable earnings thereon. In other words, any conservative amortization charge would condemn the purchase if based on the current patent situation alone. On the other hand, the market price may be justified if, in the future, the company can maintain its patent and license control of the industry by means of improvements in the art. This it has been able to do in the past. It may be benefited also by an increased use of machinery as against hand manufacture due to constantly lower selling prices for cigars. Obviously, therefore, the evaluation of this issue is essentially a matter for industry analysis and forecasting, and not for the application of investment accounting technique to a definite state of facts. Rules summarized. Our lengthy discussion of amortization policies may be summarized in the following rules. Rule 1. The company's amortization charges are to be accepted in analysis whenever both A. They are based on regular accounting rules applied to fair valuations of the fixed assets, and B. The net plant account has not decreased over a period of years. Rule 2. The company's charges may be reduced in the analyst's calculations if they regularly exceed the cash expenditures on the property. In such a case, the average cash expenditures may be deducted from earnings as a provisional depreciation charge, and the balance of depreciation included as part of the obsolescence hazard, which tends to reduce the valuation of the average cash earning power. The obsolescence allowance will be based upon the price paid for the enterprise by the investor and not upon either the book value or the reproduction cost of the fixed assets. Rule 3. The company's charges must be increased in the analyst's calculations if they are both less than the average cash expenditures on the property and less than the reserve required by ordinary accounting rules applied to the fair value of the fixed assets used in the business. Contingency and similar reserves. Conservatively managed companies in former days were wont to charge certain arbitrary amounts against the earnings of good years to absorb any special losses that might later arise, usually in a bad year. The intent of this policy was to equalize the earnings in prosperity and depression. In this respect, it resembled the use of accumulated earnings of subsidiary companies discussed in Chapter 33. Experience has shown that such devices for artificially modifying the actual earnings are too readily open to abuse. Intelligent financial opinion, as represented by the New York Stock Exchange, insists, therefore, that the management disclose the true results of each year and leave all equalization and averaging to be done by the stockholders. Examples. The annual report of the Coca-Cola Company for 1928 stated that the company's position has been greatly strengthened during the last 5 years by setting aside a reserve for contingencies of approximately $5 million. Reports for the preceding 5 years showed that the reserve had been accumulated by charges against income in varying amounts and for miscellaneous purposes. In the years 1929 to 1939, the policy was continued, except in 1933 and 1934, with the result that the reserve for contingencies and miscellaneous operations set up by charges against income amounted to $13,011,479 at the end of 1939. In 1939, Continental Steel Company deducted $300,000 as a reserve for contingencies from its reported earnings for the second half year, reducing the earnings per share from $4.62 to $3.13. Use of contingency and similar reserves to distort the earnings picture. During the years 1931 and 1932, however, contingency and similar reserves were resorted to by many companies with the effect of greatly obscuring and confusing their annual statements. These reserves were created for a threefold purpose. 1. To permit losses to be charged against surplus instead of against income. 2. To gloss over the actual taking of the loss. And 3. In some cases, to lay the groundwork for inflated earnings in subsequent years. A detailed analysis of the reports of American Commercial Alcohol Corporation for 1931 and 1932 may serve to make these points clearer to the reader. The results for the 2 years, as given by the company in its annual statements, were as shown in a table that may be found in the accompanying PDF. From these figures, it would appear that the company had about broken even during the two Depression years taken together, and that it had realized substantial earnings during 1932. But the balance sheets covering this period point to an entirely different conclusion. These balance sheets show that instead of a merely nominal loss of $11,000 for the 2 years together, there was an actual shrinkage of $1,600,000 in the company's surplus, the greater part of which was represented by an increase in current debt. The extraordinary discrepancy between these two exhibits was brought about by the exclusion from the income account of numerous losses and deductions, which were charged against surplus instead. This simple device was made more complicated, and therefore not so readily intelligible to stockholders, by the use of 3 stages of accounting procedure, viz. 1. The transfer of a large amount from capital to capital surplus. 2. The transfer of various sums from capital surplus to reserves. 3. The charging of various losses against these reserves and of other losses directly against surplus. At the end of 1931, American Commercial Alcohol transferred the sum of $4,875,000 from capital to capital surplus. It then used $576,000 of this capital surplus to cancel the accumulated profit and loss deficit. The entries in the surplus account for 1931 and 1932 show a remarkable assortment of extraordinary losses and adjustments. This table may be found in the accompanying PDF. It is evident that a substantial part of these charges against surplus actually represented operating losses, which were responsible in turn for the large increase in current liabilities. It should be noted furthermore that the company carried forward into 1933 a new contingency reserve of $400,000, against which might be charged future losses that properly should reflect themselves in the income account. Hence, the accounting procedure of this company, as well as of many others in 1931 and 1932, not only concealed the true extent of the losses suffered, but also was calculated to understate the losses or to overstate the profits of succeeding years. A particular and frequent type of contingency reserve is a reserve for future inventory decline. In our discussion of various permissible methods of figuring inventory in Chapter 32, we pointed out that the normal stock method aims to mark down the basic stock to so low a figure that no drop in price will require further charge against earnings. This method involves, in essence, the use of a contingency reserve for future inventory decline, calculated in accordance with a definite and continuing policy. On the whole, we must regard a device of this kind as meriting praise rather than criticism. But it is essential that the analyst allow for the use of such reserves when studying a single year's results, and particularly when comparing several companies in the same field. Let us further remind the reader that the setting up of an inventory reserve out of surplus, whatever the theory behind it, almost invariably results in overstating the reported profits over a period of years. Chapter 37. Significance of the earnings record. In the last 6 chapters, our attention was devoted to a critical examination of the income account for the purpose of arriving at a fair and informing statement of the results for the period covered. The second main question confronting the analyst is concerned with the utility of this past record as an indicator of future earnings. This is at once the most important and the least satisfactory aspect of security analysis. It is the most important because the sole practical value of our laborious study of the past lies in the clue it may offer to the future. It is the least satisfactory because this clue is never thoroughly reliable and it frequently turns out to be quite valueless. These shortcomings detract seriously from the value of the analyst's work, but they do not destroy it. The past exhibit remains a sufficiently dependable guide in a sufficient proportion of cases to warrant its continued use as the chief point of departure in the valuation and selection of securities. The concept of earning power. The concept of earning power has a definite and important place in investment theory. It combines a statement of actual earnings shown over a period of years with a reasonable expectation that these will be approximated in the future unless extraordinary conditions supervene. The record must cover a number of years, first because a continued or repeated performance is always more impressive than a single occurrence, and secondly because the average of a fairly long period will tend to absorb and equalize the distorting influences of the business cycle. A distinction must be drawn, however, between an average that is the mere arithmetical resultant of an assortment of disconnected figures and an average that is normal or modal in the sense that the annual results show a definite tendency to approximate the average. The contrast between one type of earning power and the other may be clear from the following examples. The average earnings of about $4.50 per share shown by S.H. Kress & Company, which may be found in the accompanying PDF, can truly be called its indicated earning power, for the reason that the figures of each separate year show only moderate variations from this norm. On the other hand, the Hudson Motors average of $4.75 per share is merely an abstraction from 10 widely varying figures, and there was no convincing reason to believe that the earnings from 1933 onward would bear a recognizable relationship to this average. A similar conclusion was drawn from our discussion of the exhibit of J.I. Case Company earlier. These conclusions, reached in 1933, are supported by the results of the 6 years following. Again, this may be found in the accompanying PDF. Quantitative analysis should be supplemented by qualitative considerations. In studying earnings records, an important principle of security analysis must be borne in mind. Quantitative data are useful only to the extent that they are supported by a qualitative survey of the enterprise. In order for a company's business to be regarded as reasonably stable, it does not suffice that the past records should show stability. The nature of the undertaking, considered apart from any figures, must be such as to indicate an inherent permanence of earning power. The importance of this additional criterion was well illustrated by the case of the Studebaker Corporation, which was used as an example in our discussion of qualitative factors in analysis on page 87 earlier. It is possible, on the other hand, that there may be considerable variation in yearly earnings, but there is a reasonable basis nevertheless for taking the average as a rough index at least of future performance. In 1934, we cited United States Steel Corporation as a leading case in point. The text of our discussion was as follows. The annual earnings for 1923 to 1932 may be found in the accompanying PDF. If compared with those of Studebaker for 1920 to 1929, the foregoing earnings show much greater instability. Yet the average of about $8 per share for the 10-year period has far more significance as a guide to the future than had Studebaker's indicated earning power of about $6.75 per share. This greater dependability arises from the entrenched position of United States Steel in its industry and also from the relatively narrow fluctuations in both the annual output and the profit per ton over most of this period. These two elements may be used as a basis for calculating approximate normal earnings of U.S. Steel somewhat as follows. Normal or usual annual production of finished goods, 13 million tons. Gross receipts per ton of finished products, $100. Net earnings per ton before depreciation, $12.50. Net earnings on 13 million tons, $160 million. Depreciation, bond interest, and preferred dividends, $90 million. Balance for 8,700,000 shares of common, $70 million. Normal earnings per share, $8. The average earnings for the 1923 to 1932 decade are thus seen to approximate a theoretical figure based upon a fairly well-defined normal output and profit margin. The increase in number of shares outstanding prevents this normal figure from exceeding the 10-year average. Although a substantial margin of error must be allowed for in such a computation, it at least supplies a starting point for an intelligent estimate of future probabilities. Examining this analysis 6 years later, we may draw some conflicting conclusions as to its value. United States Steel's earnings did recover to $7.88 per share in 1937, $8.31 before the surtax on undistributed profits. The price advanced from the 1933 average of 45.5 to a high of 126 in March 1937. Hence our implication that the company had a better earning power than the 1932 results and stock prices reflected would seem to have been amply justified by the event. But actually, the average earnings for 1934 to 1939 have been quite disappointing, amounting to no more than 14 cents per share. If these results have as much validity for the steel industry as they have for most lines of business, we should have to admit that the analysis based on 1923 to 1932 was not really useful, because the underlying conditions in steel have changed for the worse. The change consists chiefly in much higher unit costs and a lower average output, selling prices on the whole having been well maintained. Current earnings should not be the primary basis of appraisal. The market level of common stocks is governed more by their current earnings than by their long-term average. This fact accounts in good part for the wide fluctuations in common stock prices, which largely, though by no means invariably, parallel the changes in their earnings between good years and bad. Obviously, the stock market is quite irrational in thus varying its valuation of a company proportionately with the temporary changes in its reported profits. A private business might easily earn twice as much in a boom year as in poor times, but its owner would never think of correspondingly marking up or down the value of his capital investment. This is one of the most important lines of cleavage between Wall Street practice and the canons of ordinary business. Because the speculative public is clearly wrong in its attitude on this point, it would seem that its errors should afford profitable opportunities to the more logically minded to buy common stocks at the low prices occasioned by temporarily reduced earnings and to sell them at inflated levels created by abnormal prosperity. The classical formula for beating the stock market. We have here the long accepted and classical formula for beating the stock market. Obviously, it requires strength of character in order to think and to act in opposite fashion from the crowd, and also patience to wait for opportunities that may be spaced years apart. But there are still other considerations that greatly complicate this apparently simple rule for successful operations in stocks. In actual practice, the selection of suitable buying and selling levels becomes a difficult matter. Taking the long market cycle of 1921 to 1933, an investor might well have sold out at the end of 1925 and remained out of the market in 1926 through 1930 and bought again in the Depression year of 1931. The first of these moves would later have seemed a bad mistake of judgment, and the last would have had most disturbing consequences. In other market cycles of lesser amplitude, such serious miscalculations are not so likely to occur, but there is always a good deal of doubt with regard to the correct time for applying the simple principle of buy low and sell high. It is true also that underlying values may change substantially from one market cycle to another, more so, of course, in the case of individual issues than for the market as a whole. Hence, if a common stock is sold at what seems to be a generous price in relation to the average of past earnings, it may later so improve its position as to justify a still higher quotation even in the next depression. The converse may occur in the purchase of securities at subnormal prices. If such permanent changes did not frequently develop, it is doubtful if the market would respond so vigorously to current variations in the business picture. The mistake of the market lies in its assumption that, in every case, changes of this sort are likely to go farther, or at least to persist, whereas experience shows that such developments are exceptional and that the probabilities favor a swing of the pendulum in the opposite direction. The analyst cannot follow the stock market in its indiscriminate tendency to value issues on the basis of current earnings. He may on occasion attach predominant weight to the recent figures rather than to the average, but only when persuasive evidence is at hand pointing to the continuance of these current results. average versus trend of earnings. In addition to emphasizing strongly the current showing of a company, the stock market attaches great weight to the indicated trend of earnings. In Chapter 27, we pointed out the twofold danger inherent in this magnification of the trend, the first being that the supposed trend might prove deceptive, and the second being that valuations based upon trend obey no arithmetical rules and therefore may too easily be exaggerated. There is indeed a fundamental conflict between the concepts of the average and of the trend as applied to an earnings record. This may be illustrated by the following simplified example found in the accompanying PDF. On the basis of these figures, the better the trend when compared with the same current earnings, in this case $7 per share, the poorer the average, and the higher the average, the poorer the trend. They suggest an important question respecting the theoretical and practical interpretation of earnings records. Is not the trend at least as significant for the future as the average? Concretely, in judging the probable performance of companies A and C over the next 5 years, would not there be more reason to think in terms of a sequence of $8, $9, $10, $11, and $12 for A, and a sequence of $7, $6, $5, $4, and $3 for C, rather than in terms of the past average of $4 for A and $10 for C? The answer to this problem derives from common sense rather than from formal or a priori logic. The favorable trend of Company A's results must certainly be taken into account, but not by a mere automatic projection of the line of growth into the distant future. On the contrary, it must be remembered that the automatic or normal economic forces militate against the indefinite continuance of a given trend. Competition, regulation, the law of diminishing returns, etc., are powerful foes to unlimited expansion, and in smaller degree, opposite elements may operate to check a continued decline. Hence, instead of taking the maintenance of a favorable trend for granted, as the stock market is wont to do, the analyst must approach the matter with caution, seeking to determine the causes of the superior showing and to weigh the specific elements of strength in the company's position against the general obstacles in the way of continued growth. Attitude of analyst where trend is upward. If such a qualitative study leads to a favorable verdict, as frequently it should, the analyst's philosophy must still impel him to base his investment valuation on an assumed earning power no larger than the company has already achieved in a period of normal business. This is suggested because, in our opinion, investment values can be related only to demonstrated performance, so that neither expected increases nor even past results under conditions of abnormal business activity may be taken as a basis. As we shall point out in the next chapter, this assumed earning power may properly be capitalized more liberally when the prospects appear excellent than in the ordinary case. But we shall also suggest that the maximum multiplier be held to a conservative figure, say 20 under the conditions of 1940, if the valuation reached is to be kept within strictly investment limits. On this basis, assuming that general business conditions in the current year are not unusually good, the earning power of Company A might be taken at $7 per share, and its investment value might be set as high as $140. The divergence in method between the stock market and the analyst, as we define his viewpoint, would mean in general that the price levels ruling for the so-called good stocks under normal market conditions are likely to appear overgenerous to the conservative student. This does not mean that the analyst is convinced that the market valuation is wrong, but rather that he is not convinced that its valuation is right. He would call a substantial part of the price a speculative component in the sense that it is paid not for demonstrated but for expected results. This subject is discussed further in Chapter 39. Attitude of analyst where trend is downward. Where the trend has been definitely downward, as that of Company C, the analyst will assign great weight to this unfavorable factor. He will not assume that the down curve must presently turn upward, nor can he accept the past average, which is much higher than the current figure, as a normal index of future earnings. But he will be equally chary about any hasty conclusions to the effect that the company's outlook is hopeless, that its earnings are certain to disappear entirely, and that the stock is therefore without merit or value. Here again, a qualitative study of the company's situation and prospects is essential to forming an opinion whether at some price, relatively low of course, the issue may not be a bargain despite its declining earnings trend. Once more, we identify the viewpoint of the analyst with that of a sensible businessman looking into the pros and cons of some privately owned enterprise. To illustrate this reasoning, we append the record of net earnings for 1925 to 1933 of Continental Baking Corporation and American Laundry Machinery Company. These statistics may be found in the accompanying PDF. The profits of American Laundry Machinery reveal an uninterrupted decline, and the trend shown by Continental Baking is almost as bad. It will be noted that in 1929, the peak of prosperity for most companies, the profits of these concerns were substantially less than they were 4 years earlier. Wall Street reasoning would be prone to conclude from this exhibit that both enterprises are definitely on the downward path, but such extreme pessimism would be far from logical. A study of these two businesses from the qualitative standpoint would indicate first that the respective industries are permanent and reasonably stable, and secondly that each company occupies a leading position in its industry and is well fortified financially. The inference would properly follow that the unfavorable tendency shown during 1925 to 1932 was probably due to accidental or non-permanent conditions, and that in gauging the future earning power, more enlightenment will be derived from the substantial average than from the seemingly disastrous trend. Deficits a qualitative, not a quantitative factor. When a company reports a deficit for the year, it is customary to calculate the amount in dollars per share or in relation to interest requirements. The statistical manuals will state, for example, that in 1932, United States Steel Corporation earned its bond interest deficit 12.40 times, and that it showed a deficit of $11.08 per share on its common stock. It should be recognized that such figures, when taken by themselves, have no quantitative significance, and that their value in forming an average may often be open to serious question. Let us assume that Company A lost $5 per share of common in the last year, and Company B lost $7 per share. Both issues sell at $25. Is this an indication of any sort that Company A stock is preferable to Company B stock? Obviously not, for assuming it were so, it would mean that the more shares there were outstanding, the more valuable each share would be. If Company B issues 2 shares for 1, the loss would be reduced to $3.50 per share, and on the assumption just made, each new share would then be worth more than an old one. The same reasoning applies to bond interest. Suppose that Company A and Company B each lost $1 million in 1932. Company A has $4 million of 5% bonds, and Company B has $10 million of 5% bonds. Company A would then show interest earned deficit 5 times, and Company B would earn its interest deficit 2 times. These figures should not be construed as an indication of any kind that Company A's bonds are less secure than Company B's bonds, for if so, it would mean that the smaller the bond issue, the poorer its position, a manifest absurdity. When an average is taken over a period that includes a number of deficits, some question must arise as to whether or not the resultant figure is really indicative of the earning power, for the wide variation in the individual figures must detract from the representative character of the average. This point is of considerable importance in view of the prevalence of deficits during the Depression of the 1930s. In the case of most companies, the average of the year since 1933 may now be thought more representative of indicated earning power than, say, a 10-year average 1930 to 1939. Intuition not a part of the analyst's stock in trade. In the absence of indications to the contrary, we accept the past record as a basis for judging the future. but the analyst must be on the lookout for any such indications to the contrary. Here we must distinguish between vision or intuition on the one hand and ordinary sound reasoning on the other. The ability to see what is coming is of inestimable value, but it cannot be expected to be part of the analyst's stock in trade. If he had it, he could dispense with analysis. He can be asked to show only that moderate degree of foresight which springs from logic and from experience intelligently pondered. It was not to be demanded of the securities statistician, for example, that he foretell the enormous increase in cigarette consumption since 1915, or the decline in the cigar business, or the astonishing stability of the snuff industry, nor could he have predicted, to use another example, that the two large can companies would be permitted to enjoy the full benefits from the increasing demand for their product without the intrusion of that demoralizing competition which ruined the profits of even faster growing industries, for example, radio. Analysis of the future should be penetrating rather than prophetic. Analytical reasoning with regard to the future is of a somewhat different character, being penetrating rather than prophetic. Example: let us take the situation presented by Intertype Corporation in March through July 1939, when the stock was selling at $8 per share. This old, established company was one of the leaders in a relatively small industry, line casting machines, etc., for the printing trade. Its recent earnings had not been favorable, nor did there seem to be any particular reason for optimistic expectations as to the near-term outlook. The analyst, however, could not fail to be impressed by the balance sheet, which showed net current assets available for the stock amounting to close to $20 per share. The 10-year earnings, dividend, and price record of the common stock was as shown in the table on page 483, found in the accompanying PDF. Certainly there is nothing attractive in this record, marked as it is by irregularity and the absence of a favorable trend. But although these facts would undoubtedly condemn the issue in the eyes of the speculator, the reasoning of the analyst might conceivably run along different lines. The essential question for him would be whether or not the company can be counted on to remain in business and to participate about as before in good times and bad. On this point consideration of the industry, the company's prominent position in it and the strong financial setup would clearly suggest an affirmative answer. If this were granted, the analyst would then point out that the shares could be bought at $8 with very small chance of ultimate loss, and with every indication that under the next set of favorable conditions the value of the stock would double. Note that in 3 years out of the past 5 and in 6 out of the past 10, the stock sold between 2 and 4 times the July 1939 price. This type of reasoning, it will be noted, lays emphasis not upon an accurate prediction of future trends, but rather on reaching the general conclusion that the company will continue to do business pretty much as before. Wall Street is inclined to doubt that any such presumption may be applied to companies with an irregular trend, and to consider that it is just as difficult and hazardous to reach a conclusion of this kind as to determine that a growing company will continue to grow. But in our view, the intertype form of reasoning has two definite advantages over the customary attitude. For example, that which would prefer a company such as Coca-Cola at 22 times recent earnings and 35 times its asset value because of the virtually uninterrupted expansion of its profits for more than 15 years. The first advantage is that, after all, private business is conducted and investments made therein on the same kind of assumptions that we have made with respect to intertype. The second is that reasoning of this kind can be conservative in that it allows for a liberal margin of safety in case of error or disappointment. It runs considerably less risk of confusion between confidence in the future and mere speculative enthusiasm. Large profits frequently transitory. More frequently, we have the opposite type of situation from that just discussed. Here, the analyst finds reason to question the indefinite continuance of past prosperity. Examples: consider a company like J.W. Watson, Stabilator Company engaged chiefly in the manufacture of a single type of automotive accessory. The success of such a gadget is normally short-lived. Competition and changes in the art are an ever-present threat to the stability of earning power. Hence, in such a case, the student could have pointed out that the market price, bearing the usual ratio to current and average earnings, reflected a quite unwarranted confidence in the permanence of profits that by their nature were likely to be transitory. Some of the pertinent data relative to this judgment are given in the table below, found in the accompanying PDF, with respect to this company. A similar consideration would apply to the exhibit of Cody Inc. in 1928. Here was a company with an excellent earnings record, but the earnings were derived from the popularity of a trademarked line of cosmetics. This was a field in which the variable tastes of femininity could readily destroy profits as well as build them up. The inference that rapidly rising profits in previous years meant much larger profits in the future was thus especially fallacious in this case, because by the nature of the business, a peak of popularity was likely to be reached at some not distant point, after which a substantial falling off would be, if not inevitable, at least highly probable. Some of the data appearing on the Cody exhibit are as follows in the chart that may be found in the accompanying PDF. At the high price of $82 in 1929, Cody Inc. was selling in the market for about $120 million, or 30 times its maximum earnings. The actual investment in the business, capital and surplus, amounted to about $14 million. Subsequent earnings were as shown in the table following, found in the accompanying PDF. A third variety of this kind of reasoning could be applied to the brewery stock flotations in 1933. These issues showed substantial current or prospective earnings based upon capacity operations and the indicated profit per barrel. Without claiming the gift of second sight, an analyst could confidently predict that the flood of capital being poured into this new industry would ultimately result in overcapacity and keen competition. Hence, a continued large return on the actual cash investment was scarcely probable. It was likely, moreover, that many of the individual companies would prove financial failures, and most of the others would be unable to earn enough to justify the optimistic price quotations engendered by their initial success. Chapter 38. Specific reasons for questioning or rejecting the past record. In analyzing an individual company, each of the governing elements in the operating results must be scrutinized for signs of possible unfavorable changes in the future. This procedure may be illustrated by various examples drawn from the mining field. The four governing elements in such situations would be 1. Life of the mine, 2. Annual output, 3. Production costs, and 4. Selling price. The significance of the first factor has already been discussed in connection with charges against earnings for depletion. Both the output and the costs may be affected adversely if the ore to be mined in the future differs from that previously mined in location, character, or grade. Rate of output and operating costs. Examples: Calumet and Hecla Consolidated Copper Company. The reports of this copper producer for 1936 and previous years illustrate various questions with respect to ore reserves. The income account for 1936 may be summarized as follows. Copper produced 78,500,000 pounds. Copper sold 95,200,000 pounds at $9.80. Profit before depreciation and depletion, $3,855,000. Depreciation, $1,276,000. Depletion, $1,726,000. Earned per share after depreciation but before depletion on 2,006,000 shares, $1.29. Early in 1937, the stock sold at $20 per share. a valuation of $40 million for the company, or $30 million for the mining properties plus $10 million for the working capital. A detailed analysis of the makeup of the 1936 earnings would have shown them to be derived from 4 separate sources, as may be seen in the accompanying PDF. Of these 4 sources of profit, all but the smallest were definitely limited in life. The sale of copper produced in prior years was obviously non-recurring. The mainstay of the company's production for 70 years, the conglomerate branch, was facing exhaustion in the course of 12 or 14 months. The reclamation plant copper, recovered by reworking old tailings and providing the cheapest metal, was limited to a life of 5 to 7 years. There remained as the only more permanent source of future output the Amique mine, which was the highest cost operation and which had therefore been shut down from April 1932 through 1935. There were also certain other high-cost properties that were still shut down in 1936. Analysis would indicate, therefore, that probably not more than a total of some 7 to 8 millions in profit could be expected in the future from the conglomerate and the reclamation operations. Hence, aside from new developments of a speculative character, the greater part of the 40 millions of valuation for the company would have to be supported by earnings from higher-cost properties, which had contributed only a minor part of the 1936 results. Freeport Sulphur Company. The exhibit of the then Freeport, Texas Company in 1933 supplies the same type of problem for the analyst, and it also raises the question of the propriety of the use, under such circumstances, of the past earnings record to support the sale of new securities. An issue of $2,500,000 of 6% cumulative convertible preferred stock was sold at $100 per share in January 1933 in order to raise funds to equip a new sulfur property leased from certain other companies. The offering circular stated, among other things, 1. That the sulfur reserves had an estimated life of at least 25 years based upon the average annual sales for 1928 to 1932. 2. That the earnings for the period 1928 to 1932 averaged $2,952,500, or 19.6 times the preferred dividend requirement. The implication of these statements would be that, assuming no change in the price received for sulfur, the company could confidently be expected to earn over the next 25 years approximately the amounts earned in the past. The facts in the case, however, did not warrant any such deduction. The company's past earnings were derived from the operation of 2 properties, at Bryan Mound and at Hoskins Mound, respectively. The Bryan Mound area was owned by the company and had contributed the bulk of the profits, but by 1933 its life was definitely limited, in the words of the listing application. In fact, the reserves were not likely to last more than about 3 years. The Hoskins Mound was leased from the Texas Company. After paying $1.06 per ton fixed royalty, no less than 70% of the remaining profits were payable to Texas Company as rental. 1/2 of Freeport's sales were required to be made from sulfur produced at Hoskins. The new property at Grand Ecal, Louisiana, now to be developed, would require royalty payments amounting to some 40% of the net earnings. When these facts are studied, it will be seen that the earnings of Freeport, Texas for 1928 to 1932 had no direct bearing on the results to be expected from future operations. The sulfur reserves, stated to be good for 25 years, represented mineral located in an entirely different place and to be extracted under entirely different conditions from those obtaining in the past. A large profit-sharing royalty would be payable on the sulfur produced from the new project, whereas the old Bryan Mound was owned outright by Freeport, and hence its profits accrued 100% to the company. In addition to this known element of higher cost, great stress must be laid also upon the fact that the major future profits of Freeport were now expected from a new project. The Grand Ecal property was not yet equipped and in operation, and hence it was subject to the many hazards that attach to enterprises in the development stage. The cost of production at the new mine might conceivably be much higher or much lower than at Bryan Mound. From the standpoint of security analysis, the important point is that where two quite different properties are involved, you have two virtually separate enterprises. Hence, the 1928 to 1932 record of Freeport, Texas, was hardly more relevant to its future history than were the figures of some entirely different sulfur company, for example, Texas Gulf Sulfur. Returning once more to the businessman's viewpoint on security values, the Freeport, Texas exhibit suggests the following interesting line of reasoning. In June 1933, this enterprise was selling in the market for about $32 million. 25,000 shares of preferred at $125 and 730,000 shares of common at $40. The major portion of its future profits were expected to be derived from an investment of $3 million to equip a new property leased from 3 large oil companies. Presumably, these oil companies drove as good a bargain for themselves as possible in the terms of the lease. The market was in effect placing a valuation of some $20 million or more upon a new enterprise in which only $3 million was to be invested. It was possible, of course, that this enterprise would prove to be worth much more than 6 times the money put into it. But from the standpoint of ordinary business procedure, the payment of such an enormous premium for anticipated future results would appear imprudent in the extreme. Evidently, the stock market, like the heart in the French proverb, has reasons all its own. In the writer's view, where these reasons depart violently from sound sense and business experience, common stock buyers must inevitably lose money in the end, even though large speculative gains may temporarily accrue, and even though certain fortunate purchases may turn out to be permanently profitable. The future price of the product. The 3 preceding examples related to the future continuance of the rate of output and the operating costs upon which the past record of earnings was predicted. We must also consider such indications as may be available in regard to the future selling price of the product. Here we must ordinarily enter into the field of surmise or of prophecy. The analyst can truthfully say very little about future prices except that they fall outside the realm of sound prediction. Now and then a more illuminating statement may be justified by the facts. Adhering to the mining field for our examples, we may mention the enormous profits made by zinc producers during the Great War because of the high price of spelter. Butte and Superior Mining Company earned no less than $64 per share before depreciation and depletion in the 2 years 1915 to 1916, as the result of obtaining about 13 cents per pound for its output of zinc against a pre-war average of about 5 1/4 cents. Obviously, the future earning power of this company was almost certain to shrink far below the wartime figures, nor could these properly be taken together with the results of any other years in order to arrive at the average or supposedly normal earnings. Change in status of low-cost producers. The copper mining industry offers an example of wider significance. An analysis of companies in this field must take into account the fact that since 1914, a substantial number of new low-cost producers have been developed and that other companies have succeeded in reducing extraction costs through metallurgical improvements. This means that there has been a definite lowering of the center of gravity of production costs for the entire industry. Other things being equal, this would make for a lower selling price in the future than obtained in the past. Such a development is more strikingly illustrated by the crude rubber industry. Differently stated, mines that formerly rated as low-cost producers, that is, as having costs well below the average, may have lost this advantage unless they have also greatly improved their technique of production. The analyst would have to allow for these developments in his calculations by taking a cautious view of future copper prices, at least as compared with the pre-war or the pre-depression average. Anomalous prices and price relationships in the history of the IRT system. The checkered history of the interborough rapid transit system in New York City has presented a great variety of divergences between market prices and the real or relative values ascertainable by analysis. Two of these discrepancies turn upon the fact that, for specific reasons, the then current and past earnings should not have been accepted as indicative of future earning power. In abbreviated form, the details of these two situations are as follows. For a number of years prior to 1918, the Interborough Rapid Transit Company was very prosperous. In the 12 months ended June 30th, 1917, it earned $26 per share on its capital stock and paid dividends of $20 per share. Nearly all of this stock was owned by Interborough Consolidated Corporation, a holding concern previously called Interborough Metropolitan Corporation, which in turn had outstanding collateral trust bonds, 6% preferred stock, and common stock. Including its share of the undistributed earnings of the operating company, it earned about $11.50 per share on its preferred stock and about $2.50 on the common. The preferred sold in the market at 60 and the common at 10. These issues were actively traded in, and they were highly recommended to the public by various financial agencies, which stressed the phenomenal growth of the subway traffic. A modicum of analysis would have shown that the real picture was entirely different from what appeared on the surface. New rapid transit facilities were being constructed under contract between the City of New York and the Interborough, as well as others under contract between the city and the Brooklyn Rapid Transit Company. As soon as the new lines were placed in operation, which was to be the following year, the earnings available for Interborough were to be limited under this contract to the figure prevailing in 1911 to 1913, which was far less than the current profits. The city would then be entitled to receive a high return on its enormous investment in the new lines. If and after all such payments were made in full, including back accruals, the city and the Interborough would then share equally in surplus profits. However, the preferential payments due the city would be so heavy that experts had testified that under the most favorable conditions, it would be more than 30 years before there could be any surplus income to divide with the company. The subjoined brief table that may be found in the accompanying PDF shows the significance of these facts. The underlying facts proved beyond question, therefore, that instead of a brilliant future being in store for Interborough, it was destined to suffer a severe loss of earning power within a year's time. It would then be quite impossible to maintain the $6 dividend on the holding company's preferred stock, and no earnings at all would be available for the common for a generation or more. On this showing, it was mathematically certain that both Interborough consolidated stock issues were worth far less than their current selling prices. The sequel not only bore out this criticism, which it was bound to do, but demonstrated also that where an upper limit of earnings or value is fixed, there is usually danger that the actual figure will be less than the maximum. The opening of the new subway lines coincided with a large increase in operating costs due to wartime inflation, and also, as was to be expected, it diminished the profits of the older routes. Interborough Rapid Transit Company was promptly compelled to reduce its dividend, and it was omitted entirely in 1919. In consequence, the holding company, Interborough Consolidated, suspended its preferred dividends in 1918. The next year, it defaulted the interest on its bonds, became bankrupt, and disappeared from the scene, with the complete extinction of both its preferred and common stock. 2 years later, Interborough Rapid Transit Company, recently so prosperous, barely escaped an imminent receivership by means of a voluntary reorganization, which extended a maturing note issue. When this extended issue matured in 1932, the company was again unable to pay, and this time receivers took over the property. During the 10-year period between the two receivership applications, another earnings situation developed, somewhat similar to that of 1917. In 1928, the Interborough reported earnings of $3 million, or $8.50 per share for its common stock, and the shares sold as high as 62. But these earnings included $4 million of back preferential from the subway division. The latter represented a limited amount due the Interborough Rapid Transit out of subway earnings to make good a deficiency in the profits of the early years of operating the new lines. On June 30, 1928, the amount of back preferential remaining to be paid the company was only $1,413,000. Hence, all the profits available for Interborough stock were due to a special source of revenue that could continue for only a few months longer. Heedless speculators, however, were capitalizing as permanent and earning power of Interborough stock, which analysis would show was of entirely non-recurrent and temporary character. Chapter 39. Price-earnings ratios for common stocks, adjustments for changes in capitalization. In previous chapters, various references have been made to Wall Street's ideas on the relation of earnings to values. A given common stock is generally considered to be worth a certain number of times its current earnings. This number of times, or multiplier, depends partly on the prevailing psychology and partly on the nature and record of the enterprise. Prior to the 1927 to 1929 bull market, 10 times earnings was the accepted standard of measurement. More accurately speaking, it was the common point of departure for valuing common stocks, so that an issue would have to be considered exceptionally desirable to justify a higher ratio, and conversely. Beginning about 1927, the 10 times earnings standard was superseded by a rather confusing set of new yardsticks. On the one hand, there was a tendency to value common stocks in general more liberally than before. This was summarized in a famous dictum of a financial leader implying that good stocks were worth 15 times their earnings. There was also the tendency to make more sweeping distinctions in the valuations of different kinds of common stocks. Companies in especially favored groups, for example public utilities and chain stores, in 1928 to 1929, sold at a very high multiple of current earnings, say 25 to 40 times. This was true also of the blue chip issues, which comprised leading units in miscellaneous fields. As pointed out before, these generous valuations were based upon the assumed continuance of the upward trend shown over a longer or shorter period in the past. Subsequent to 1932, there developed a tendency for prices to rule higher in relation to earnings because of the sharp drop in long-term interest rates. Exact appraisal impossible. Security analysis cannot presume to lay down general rules as to the proper value of any given common stock. Practically speaking, there is no such thing. The bases of value are too shifting to admit of any formulation that could claim to be even reasonably accurate. The whole idea of basing the value upon current earnings seems inherently absurd, since we know that the current earnings are constantly changing. And whether the multiplier should be 10 or 15 or 30 would seem, at bottom, a matter of purely arbitrary choice. But the stock market itself has no time for such scientific scruples. It must make its values first and find its reasons afterwards. Its position is much like that of a jury in a breach of promise suit. There is no sound way of measuring the values involved, and yet they must be measured somehow, and a verdict rendered. Hence, the prices of common stocks are not carefully thought-out computations, but the resultants of a welter of human reactions. The stock market is a voting machine rather than a weighing machine. It responds to factual data not directly, but only as they affect the decisions of buyers and sellers. Limited functions of the analyst in field of appraisal of stock prices. Confronted by this mixture of changing facts and fluctuating human fancies, the securities analyst is clearly incapable of passing judgment on common stock prices generally. There are, however, some concrete, if limited, functions that he may carry on in this field, of which the following are representative. 1. He may set up a basis for conservative or investment valuation of common stocks, as distinguished from speculative valuations. 2. He may point out the significance of A, the capitalization structure, and B, the source of income, as bearing upon the valuation of a given stock issue. 3. He may find unusual elements in the balance sheet which affect the implications of the earnings picture. A suggested basis of maximum appraisal for investment. The investor in common stocks, equally with the speculator, is dependent on future rather than past earnings. His fundamental basis of appraisal must be an intelligent and conservative estimate of the future earning power. But his measure of future earnings can be conservative only if it is limited by actual performance over a period of time. We have suggested, however, that the profits of the most recent year, taken singly, might be accepted as the gauge of future earnings if 1. General business conditions in that year were not exceptionally good, 2. The company has shown an upward trend of earnings for some years past, and 3. The investor's study of the industry gives him confidence in its continued growth. In a very exceptional case, the investor may be justified in counting on higher earnings in the future than at any time in the past. This might follow from developments involving a patent or the discovery of new ore in a mine or some similar specific and significant occurrence. But in most instances, he will derive the investment value of a common stock from the average earnings of a period between 5 and 10 years. This does not mean that all common stocks with the same average earnings should have the same value. The common stock investor, that is, the conservative buyer, will properly accord a more liberal valuation to those issues which have current earnings above the average or which may reasonably be considered to possess better than average prospects or an inherently stable earning power. But it is the essence of our viewpoint that some moderate upper limit must, in every case, be placed on the multiplier in order to stay within the bounds of conservative valuation. We would suggest that about 20 times average earnings is as high a price as can be paid in an investment purchase of a common stock. Although this rule is of necessity arbitrary in its nature, it is not entirely so. Investment presupposes demonstrable value, and the typical common stock's value can be demonstrated only by means of an established, that is, an average earning power. But it is difficult to see how average earnings of less than 5% upon the market price could ever be considered as vindicating that price. Clearly, such a price-earnings ratio could not provide that margin of safety which we have associated with the investor's position. It might be accepted by a purchaser in the expectation that future earnings will be larger than in the past. But in the original and most useful sense of the term, such a basis of valuation is speculative. It falls outside the purview of common stock investment. Higher prices may prevail for speculative commitments. The intent of this distinction must be clearly understood. We do not imply that it is a mistake to pay more than 20 times average earnings for any common stock. We do suggest that such a price would be speculative. The purchase may easily turn out to be highly profitable, but in that case it will have proved a wise or fortunate speculation. It is proper to remark, moreover, that very few people are consistently wise or fortunate in their speculative operations. Hence, we may submit, as a corollary of no small practical importance, that people who habitually purchase common stocks at more than about 20 times their average earnings are likely to lose considerable money in the long run. This is the more probable because, in the absence of such a mechanical check, they are prone to succumb recurrently to the lure of bull markets, which always find some specious argument to justify paying extravagant prices for common stocks. Other requisites for common stocks of investment grade and a corollary therefrom. It should be pointed out that if 20 times average earnings is taken as the upper limit of price for an investment purchase, then ordinarily the price paid should be substantially less than this maximum. This suggests that about 12 or 12.5 times average earnings may be suitable for the typical case of a company with neutral prospects. We must emphasize also that a reasonable ratio of market price to average earnings is not the only requisite for a common stock investment. It is a necessary but not a sufficient condition. The company must be satisfactory also in its financial setup and management, and not unsatisfactory in its prospects. From this principle there follows another important corollary, viz., an attractive common stock investment is an attractive speculation. This is true because if a common stock can meet the demand of a conservative investor that he get full value for his money plus not unsatisfactory future prospects, then such an issue must also have a fair chance of appreciating in market value. Examples of speculative and investment common stocks. Our definition of an investment basis for common stock purchases is at variance with the Wall Street practice in respect to common stocks of high rating. For such issues, a price of considerably more than 20 times average earnings is held to be warranted, and furthermore, these stocks are designated as investment issues, regardless of the price at which they sell. According to our view, the high prices paid for the best common stocks make these purchases essentially speculative because they require future growth to justify them. Hence, common stock investment operations, as we define them, will occupy a middle ground in the market, lying between low-price issues that are speculative because of doubtful quality and well-entrenched issues that are speculative nonetheless because of their high price. These distinctions are illustrated by the accompanying 9 examples taken as of December 31, 1938. These examples may be found in the accompanying PDF. Comments on the various groups. The companies listed in Group A are representative of the so-called first-grade or blue-chip industrials, which were particularly favored in the great speculation of 1928 to 1929 and in the markets of ensuing years. They are characterized by a strong financial position, by presumably excellent prospects, and in most cases by relatively stable or growing earnings in the past. The market price of the shares, however, was higher than would be justified by their average earnings. In fact, the profits of the best year in the 1929 to 1938 decade were less than 8% of the December 1938 market price. It is also characteristic of such issues that they sell for enormous premiums above the actual capital invested. The companies analyzed in Group B are obviously speculative because of the great instability of their earnings records. They show varying relationships of market price to average earnings, maximum earnings, and to asset values. The common stocks shown in Group C are examples of those which meet specific and quantitative tests of investment quality. These tests include the following. 1. The earnings have been reasonably stable, allowing for the tremendous fluctuations in business conditions during the 10-year period. 2. The average earnings bear a satisfactory ratio to market price. 3. The financial setup is sufficiently conservative and the working capital position is strong. Although we do not suggest that a common stock bought for investment be required to show asset values equal to the price paid, it is nonetheless characteristic of issues in Group C that, as a whole, they will not sell for a huge premium above the company's actual resources. Common stock investment, as we envisage it, will confine itself to issues making exhibits of the kind illustrated by Group C. But the actual purchase of any such issues must require also that the purchaser be satisfied in his own mind that the prospects of the enterprise are at least reasonably favorable. Allowances for changes in capitalization. In dealing with the past record of earnings, when given on a per-share basis, it is elementary that the figures must be adjusted to reflect any important changes in the capitalization which have taken place during the period. In the simplest case, these will involve a change only in the number of shares of common stock due to stock dividends, split-ups, etc. All that is necessary then is to restate the capitalization throughout the period on the basis of the current number of shares. Such recalculations are made by some of the statistical services, but not by others. When the change in capitalization has been due to the sale of additional stock at a comparatively low price, usually through the exercise of subscription rights or warrants, or to the conversion of senior securities, the adjustment is more difficult. In such cases, the earnings available for the common during the earlier period must be increased by whatever gain would have followed from the issuance of the additional shares. When bonds or preferred stocks have been converted into common, the charges formerly paid thereon are to be added back to the earnings and the new figure then applied to the larger number of shares. If stock has been sold at a relatively low price, a proper adjustment would allow earnings of, say, 5 to 8% on the proceeds of the sale. Such recalculations need not be made unless the changes indicated thereby are substantial. A corresponding adjustment of the per-share earnings must be made at times to reflect the possible future increase in the number of shares outstanding as a result of conversions or exercise of option warrants. When other security holders have a choice of any kind, sound analysis must allow for the possible adverse effect upon the per-share earnings of the common stock that would follow from the exercise of the option. Examples. This type of adjustment must be made in analyzing the reported earnings of American Airlines, Inc. for the 12 months ended September 30th, 1939. Earnings, as reported, $1,128,000. Per share on about 300,000 shares outstanding, $3.76. Price, December 1939, about 37. But there were outstanding $2,600,000 of 4.5% debentures convertible into common stock at $12.50 per share. The analyst must assume conversion of the bonds, giving the following adjusted result. Earnings adding back $117,000 interest, $1,245,000. Per share on 508,000 shares, $2.45. More than one-third of the reported earnings per share are lost when the necessary adjustment is made. American Water Works and Electric Company can be used to illustrate both types of adjustment. See the accompanying PDF. Adjustment A reflects the payment of stock dividends in 1928, 1929, and 1930. Adjustment B assumes conversion of the $15 million of convertible 5s issued in 1934, thus increasing the earnings by the amount of the interest charges, but also increasing the common stock issue by 750,000 shares. The foregoing adjustments are independent of any possible modifications in the reported earnings arising from the questioning of the depreciation charges